Okay, in this segment, we're going to look at structuring and placing the loan. So as F&I managers, when we get a deal, there's lots of different lenders that are at our disposal to use. And so a lot of times we need to look and see how the deal's structured. They're all very competitive, but certain deals require maybe a little bit different structuring guidelines for their particular situation and or credit. So as we look at it, there's lenders all want our business. They're very competitive, but there's some differences in how they advance deals and how they look at different credit scores. As I look at a deal, this will be our first example that we're going to do. As an F&I manager, there's a couple things I need to look at. I'm going to look at the advance this deal was structured at, because I need to make sure with the lenders that I'm looking at that they're in the right guidelines, that we're not over advanced. I'm going to have to look at the budget for this particular customer to make sure it fits into their debt ratio and their payment to income ratios as well. There's guidelines that cannot be exceeded. And then most importantly, I also have to look at the maximum loan to value, or the maximum dollar amount they will advance and fund for this transaction. Now, for the first deal that we're going to look at today, this particular customer is named John Smith, and he has agreed to, with his salesperson, to buy a 2017 Honda Accord. Invoice on the vehicle is $17,800. That's a manufacturer's cost to the dealer. He's agreed to a selling price of $19,900. John has $1,600 down. He's agreed to a monthly payment at $387 at 60 months. Does not have a trade. And we've given you his credit profile because the score has a little bit to do with where they're going to qualify. John's scores is 678. He makes $4,200 a month. His rent is $1,200. His auto insurance, when I calculate his debt ratio, I'm going to use $100. And the debt from his credit payments, when I add everything up on his credit bureau, it came to $195. We've also given you a quick summary of his credit as well. In addition to being a 678, he has not had any bankruptcies, repossessions, foreclosures, tax liens, judgments, charge-offs, or collection accounts. And he's actually been on the bureau for 7 years with 12 satisfied trade lines that have all been paid well as agreed. So the first thing I would want to do on this before I even look at a lender is it might be a good thing to calculate the advance this deal was structured at. So the advance, to check that, if you remember, it is selling price minus down payment divided by invoice on a new car. So let's calculate that. Customer's selling price is $19,900 minus down payment of $1,600. And somebody help me out with the math. 18,300. And I take that number and divide it by invoice because it's a new car. If it was a used car, I would use Kelly Wholesale Blue Book. Invoice is 17,800. What percent do we get for this structure? Yep, 102.8. Okay, 102.8% is how this deal was structured. Once I look at my lender guidelines, I'll know where they fall in relationship to what the lender's requirements are. So this deal was structured at 102.8%. And while we're here, let's go ahead and check payment to income so I kind of know where they're at. That's where the car payment cannot exceed a certain percent of their gross monthly income. So I will take the car payment they were quoted. So payment to income, first one I did was advance. What's the car payment?
$387 at 60.
Divided by, what's his gross monthly income? $4,200. And what do I get?
0.092.
So 9.2%. Typically, your lenders want you to be less than 20. If that's the case, I would be okay with this particular one. So car payment is definitely less than 20% of his gross monthly income. Some of them may also ask, not all of them in prime lending, but they have the right to check the debt ratio as well. So let's go ahead and check and see what the debt ratio is for the customer. That's going to be adding up their rent, insurance, credit payments, and the car payment of the car they wish to add to their monthly debt structure. So I'm going to take their rent of $1,200 plus $100 for insurance. Credit payments are $195, and the proposed car payment $387. What do those total?
1,882.
Okay, 1,882, and now I divide that by their gross monthly income to see what their actual debt ratio is. And his income is 4,200. 44.8. So we know that we're under 50% here. Payment to income's less than 20. I also know that my advance, this deal was structured at 102.8%. Now let's look at our lender guidelines. Because from here, I need to see where this customer is going to fall with this particular lender as I start to continue to build the deal. Now, as you see up here with the lender on the next page of your book, this is going to show a standard program and fast lane. Fast lane just happens to be that if a customer meets all the qualifications with credit score and they have the minimum amount of time on the bureau and they have the right satisfactory trade lines, there's no repossessions, bankruptcies, judgments, foreclosures, I can use a fast lane, which means that I can automatically approve it in many cases without having a lender do the approval for me. I would use the standard program if the customer didn't meet fast lane requirements, and then I could use that. So as we look at it, we know this customer is in the fast lane. We have a 2017 Honda Accord. It's a 60-month loan. What is his credit score?
678.
678. So based on that, for 60 months, what would be the buy rate from the lender?
6.34.
Okay, 6.34 for 60 months, right? Actually, I'll look ahead because in the event that I want to go out to 66 months, if it's necessary, I can extend it and look at the rate is exactly the same, 6.34 up to 66 months. That is our wholesale rate from the lender for this transaction. I'm going to also need to know a couple other things. What's the maximum payment to income this lender has as a requirement? If you look,
Based on his
Yep.
credit score.
look at the third tier based on his score where he qualifies, 20%. We already did that, right? We are less than 20% max payment to income. I don't see anything on here about debt ratio, but we do know it's under 50% if that were something they were looking at. So typically I'll get in the habit of doing that because other lenders may look at that as well. But this lender is not. Now the advance is also listed for me, right in that same area. The advance this lender will do is 110% of invoice on a new car, plus tax title license and my back-end products, extended service contract and gap. So with this tier, the third one at 110%, can I erase this part? You got it? Okay. This lender will do 110%, plus tax license and extended service contract and gap. And why will they extend more for those two products?
Because they want the car to be covered in case of an accident.
Helps protect the lender in case of a total loss. Also, customer, if the car mechanically has any issues, the customer will be able to afford to get those things repaired and be able to still afford also to make the monthly obligations for that loan. So this deal was structured at 102.8%. We are definitely within the lender guidelines, right, for the advance with regard to the selling price. We did not exceed 110%. Actually, There's a little bit of room left on the table, isn't there, that possibly we could use to help maximize this transaction. What percent is left in the advance from the lender? 7.2% is left. Now, it's easier to work with dollars than percentages. So let's turn that into dollars so I know what's available that we can use. Advance is calculated from what?
Selling price, selling price.
Invoice.
Okay.
Invoice, right? On a new car, blue book on a used car. So I've got 7.2 left percent in the advance. I'll multiply that times invoice. How much is left?
1281.6.
Yep, $1,281.60 is left for other products. Should the customer decide they want to purchase LoJack or paint protection, one of the other items that could be offered. So for other products, $1,281.60 are left. Because that is our job as F&I managers to see, one, not only are we in guidelines, but also if there's anything left that possibly could be utilized as well. I know I'm going to get, as a plus product, I can offer them extended service contract. In fact, if you look at the bottom left, it will tell us how much we can sell the service contract for, because they'll have caps on everything. What does it say in the fine print?
10% of the cash
Or $2,000, whichever is greater. Okay, 10% of the selling price would be, 10% of $19,900 is about $1,900. We should use the $2,000, right? Whichever is greater. We can sell a service contract up to $2,000. And gap is listed as well in here. $600 for gap. Okay? So these are the basic or beginning parameters of how this deal would look if we maximized it in every area. Now, there's a couple other things I'll look at. I already know that we cannot go, or the customer can't, more than 20% of their gross monthly income for their max payment. So I do have to watch that as well. I think in this case we'll be okay. If their income is $4,000, 20% of that would be what as a max car payment? Yep, 20% of his gross monthly income is $800. I don't think we'll get there, but in some cases it is important to watch that for budget issues. And then there's one more area I have to watch, because they're going to also watch on maximum amount financed. Now this lender doesn't have it listed on this page. It typically would be relayed to you and communicated through one of their callback sheets as well, but I'm going to say it's 140%, maximum amount financed.
That's LTV, right?
Yep, also known as loan to value, yes. Now, it's in a percentage at 140, but I want to look at dollars because dollars are easier to work with. So it's 140% of invoice, how I structured this loan. 17.8 times 140% equals
24,920.
so $24,920. These are the parameters for this deal. If I stay in guidelines, then I should get my deal funded and it should be approved. So I've got other products. I've got to spend $1,281, extended service contract, $2,000 maximum I can charge, $600 for gap, cannot exceed max car payment. If I were to exceed it before I get here, I'd have to stop. Whichever one stops you first, and then when all's said and done, the maximum loan value cannot exceed $24,920 by selecting this particular lender. Okay? Including everything, tax, title, license, down payment, extended service contract, gap, trades, anything else that could be in that number cannot exceed that final bottom line number. Like I said, sometimes the payment will get you first before you can even go to this number. with certain transactions. So let's go into Advent, and we're going to put this transaction in. I think everybody has their screen up, so let's just go to the customer and put in, the customer's name is John Smith, but I want you to use your first name, your last name is Smith. F1 twice. And just put in a name. Don't worry about the address for now, and make sure you have a source number. So we can at least remember, if we can't find it later, we can pull it back up if you lose your deal. F1 twice, yeah, one more time, F1.
I accidentally hit enter twice because it froze. But
Okay.
remember that screen that comes up?
That's fine.
That's okay if I just went back and
Yeah.
changed it? Okay.
Yeah. So now we'll go back to the deal screen. 8 to list, 2 to change. Okay, before you put numbers in, let's go over to where it says 2 to change. F12, there you go. 19.9, 16. Let's do 60 months. Okay. Make sure you do your loan at 60 months. Now, what was our buy rate? 6.34, but we're going to mark it up. And it looks like on this sheet, in the guidelines, it says we can mark it up 2 points. So let's make it 8.34 is your APR to the customer at 60 months. We just won't talk about the front profit. Okay, looks good. Everybody has a payment of $405.76. Okay, if this is our starting point. Now, let's go ahead and maximize the deal. What's the first thing a customer would probably be interested in?
Service contract.
Service contract. Go to the service contract field, left column, and hit F1. Let's go in and put a 60,000 mile, F1, 60 months, 100,000 miles. Go up here and put 8.34 under APR. 100,000 miles and cost is 600. We're going to sell it for 2. Don't worry about that's add-on rate. The loan is for 6 months more, so you're earning just a little bit more reserve. But remember, it's simple interest. So if the customer says, I don't want to have a loan that long, it's simple interest. You only pay for what you use. You can pay extra each month. You can pay off early or trade it. It's just that it gives you a little bit lower monthly payment for those months when money's a little bit tight, and just makes it a little bit easier. But you can certainly pay more should you choose to do so. Okay, any questions on this transaction? No? Okay. All right, let's move on to another one, if there are no questions.